You've done the analysis. The volume profile and moving averages align perfectly. You click the mouse to enter the trade with complete confidence. Within seconds, the market reverses. That perfect setup begins to collapse, and the position is suddenly deep in the red. You have a plan to cut your losses at this exact level. Instead, you freeze. You abandon your risk management rules and actually add money to the losing position. This raises a difficult question. Why do highly analytical people begin to act like reckless gamblers the moment their portfolio turns red? Technical strategies are designed for a rational mind, but in these high-stakes moments, an older biological process begins to override the numbers. Losing money triggers a survival mechanism very deep within the human brain. This is an amygdala hijack. In the wild, this rapid response allows humans to react to physical predators before the conscious mind even realizes there is a threat. When triggered by financial stress, the amygdala draws resources away from the prefrontal cortex. This area is responsible for discipline and strategy, and its function becomes compromised just when you need it most. As this logic center dims, your carefully crafted trading plan becomes inaccessible. You lose the ability to follow the risk management rules you set when you were calm. At this point, the focus shifts from the mathematical chart to the internal pressure of survival instincts. This shift makes self-sabotage a probable outcome of your own biology. With logic effectively sidelined, the mind defaults into one of three specific mental traps. The first is the sunk cost fallacy. This occurs when the brain equates closing a losing position with admitting defeat. This leads traders to stubbornly hold on to a toxic asset until its value reaches zero. The second trap is revenge trading. Here, a bruised ego demands that the market return the capital it just took. You might find yourself abandoning position sizing or over-leveraging the account to prove your initial thesis was correct. The third trap is the illusion of control. This is a desperate attempt to force order onto chaotic market movements to soothe rising anxiety. It often manifests as a trader drawing imaginary patterns or support lines on a chart to create a temporary sense of safety. The market remains indifferent to human emotion. Reacting to data with ego only accelerates the loss of capital. While you cannot outsmart millions of years of evolution, you can build a strict operational system to interrupt these impulses. You need a psychological circuit breaker. The cognitive reset protocol is designed to reboot your logic centers when panic begins to take hold. Step 1. The 15-minute rule. Immediately step away from the screen and touch nothing. This lets the adrenaline in your bloodstream naturally subside. Step 2 is the new trade test. Once you are calm, ask a single question. If I were holding cash right now, would I buy into this exact position at this exact price? If the honest answer is no, the position must be liquidated immediately. Step 3 is ego detachment. This involves separating your personal self-worth from the daily fluctuations of your profit and loss statement. Which of those three mental traps has been the most difficult for you to overcome? Let me know in the comments. The most significant challenge in finance resides in the space between your own ears. Mastering your biological impulses is the